So this latest projection by the World Bank says that India's fiscal deficit is expected to continue to shrink on account of growing tax revenues. In the same report, the World Bank has also projected India to remain the fastest growing major economy in FY26 and FY27 and stated that inflation is projected to remain below or within the target range in India. To discuss these projections further, I am joined by Anubhuti Sahai, Head of India Economic Research at Standard Chartered Bank, and Mitali Nikor, Senior Economist. Thank you both for your time. Anubhuti, with India's fiscal deficit expected to shrink continuously amid strong tax revenues as per the World Bank's latest projection, not only is India expected to maintain its position as the fastest growing economy among the world's largest economies, but this projection also highlights a significant boost in tax revenues and fiscal deficit shrinking.
Yeah, so we agree with the view that India is likely to remain one of the fastest growing economies. We are expecting India to grow at 6.5% in the next financial year, so tad lower, but nevertheless, the speed is pretty much there. As far as the fiscal deficit is concerned, I think a lot of emphasis has been has been put on fiscal consolidation by the current finance minister Nirmala Sitharaman. And every year, if you look at, especially after the reopening, every year the finance minister has surprised more. For instance, if you look at FY24, the target was 5.6, but the final delivery was closer to 5.2%. And even this year, we think against the promise of 4.9, probably the finance minister would deliver a 4.8%. Now, going forward, the stated path of fiscal consolidation is for this financial year is 4.5% or narrower. Our sense is 4.5% is likely to be targeted. Some support. I mean, we don't expect a very sharp consolidation in the next financial year because growth is moderating and tax collections are always, there is a fair bit of cyclicality, but we expect the fiscal consolidation to play in line with, the stated path. So yeah, pretty much agree with what the World Economic Forum has been talking about India.
Right, Mitali, your thoughts on the latest projection. Also, a deepening tax collection reflects India's dependence on a few reducing. So, how do you view this strategy of widening and deepening the tax net altogether?
So, hi, Sakshi, good morning. And it's always good to talk about, these global projections and sort of contrast them with what we're seeing, on the ground from our research at Nikor Associates. Essentially, I believe that there are two factors at play, which are coming out at this point. Firstly, if you look at the World Bank report and compare India's position with the global economic scenario, this is the first time that the bank is talking about slowing down in the growth rates amongst developing economies as a whole. So, in the first 25 years, from 2000 to 2025, developing economies as a whole have increased their share of the global GDP. They now account for almost half of the global GDP, which they didn't at the start of the 2000s. And India really standing out as a bright spot as the fastest growing emerging economy at 6.7% for 2025. And it's also taking South Asia forward, propelling South Asia forward. So now, in such a scenario, when you see widespread growth, and you see that widespread growth across the country, decentralized growth beyond just the urban centers of Delhi, Mumbai, and Chennai, Bangalore, Hyderabad, but now spreading to tier 2, tier 3, more and more cities, we will start to see, of course, a steady growth in tax collections. But at the same time, we have to check our own resilience. And we're starting to see that, for MSMEs, we need to create a more streamlined kind of GST regime. For small businesses, we need to start thinking about corporate taxation as well. We also need to think about, a new calibration of the income tax regime. All of this becomes extremely relevant with the upcoming budget. So I do think that while there is tax buoyancy, and there's definitely no question in that regard, we still have to think about tax efficiency.
Right. Lastly, Anubhuti, debt to servicing costs are projected to remain high in several countries as per this report. Your thoughts on external debt rising, in particular for low and middle income countries then?
Yeah, so if you're looking at external debt to GDP, initially there was a mention about South Asia. I think if we are looking at India, probably external debt to GDP is not so much of a concern. FX reserves are ample, and if you look at, for instance, the usual or the most fickle, if I may use the word, debt which can flow in and flow out based on a news headline, that is the FPI, portfolio investors. They hold less than 2% of Indian government bond market. They are large investors in the equity side, but of course that's not in the debt component. So I think when you're looking at India, external debt to GDP is not a concern. There are ample FX reserves. Key towards this whole pledge of the finance minister towards fiscal consolidation comes because our public debt to GDP is high. Domestic debt to GDP taken by the government is high, and therefore there is this need towards fiscal consolidation. For other economies, low middle income economies, even if I talk about like a slightly upper middle income economies, external debt to GDP is a problem. For instance, if you look at our neighbors, Sri Lanka, they went through a very difficult time or during pandemic, and they are now coming out of that challenging environment driven by reforms as well as IMF assistance. Same is also true for Bangladesh. If you go further away, countries like Egypt, etc., where external debt to GDP is high, they are likely to face more challenges given the increased volatility in dollar, and the external sector, especially from the tariff front, remains uncertain. But for India, that's not the biggest concern. The concern is domestic debt to GDP, which the government is trying to bring down by moving in on the stated path of fiscal consolidation.
All right, thank you so much, both of you, for sharing your thoughts and, of course, decoding this latest report for our viewers.